Hi everyone, in this video I'm going to look at Upstart Stock's second quarter 2022 earnings call that was held on Monday, August 8th. Of course, the stock is down considerably for the year and since this announcement was made. So let's dig into these results and see, try to decipher what's going on with Upstart stock. The CEO, David Gerard, starts it off by saying, "Today we reported a decline in revenues, which is obviously disappointing and unacceptable to us. The company has been experiencing a difficult year so far in 2022 as the macroeconomic headwinds are starting to impact the company." Moving on, the company highlights the fact that the platform experienced about a 50% reduction in credit defaults compared to the pre-COVID timeframe. And as expected, default rates returned to pre-COVID levels, or in some cases even higher, now that the economy is normalizing. So it doesn't take much to realize why this was the case. Of course, during the COVID pandemic, economies worldwide, governments sent fiscal stimulus to their citizens, and consumer balance sheets were in much better shape during the pandemic than they had ever been. Stimulus checks, boosted unemployment checks, increased child tax credit payments, and so on and so forth. You could go down the line with all of the stimulus benefits. So that led to consumers not defaulting in on their debt payments as much as they normally would have. But now that those stimulus effects are fading away, the default rates are returning to pre-COVID levels, and in some cases they're even higher. So that's troubling news. And of course, for Upstart, that's even worse because they tend to focus on lower credit rating individuals, as we'll see a little bit lower down. The CEO says, "While no one knows the future, we do expect a significant slowing of the economy and a worse than normal macro environment for the next year and beyond." This is a result of the Federal Reserve raising interest rates in an attempt to bring inflation down. And when the Federal Reserve raises interest rates, that causes economic activity to contract because interest sensitive items like homes and cars are going to cost people more money. And if something costs more money, people are going to buy less of it. And Upstart is starting to notice that in their results, and they're expecting these worse than normal events to go on for the next year and beyond. So, not good news for investors here, not good news for Upstart stock investors. One of the primary selling points for investing in Upstart stock is that they say they have a superior credit performance model, a measurement of credit. They can, because of their artificially intelligence infused credit ratings, they believe they can, their portfolio, their business model can do better than traditional credit lending standards. And here they talk about this and they say, "We believe the essential measurement for credit performance is actual dollar returns compared to the lenders or institutional investors' target at the time of origination." In other words, they think you should measure credit performance based on what did you expect at the time you made the loan and what did you actually earn, right? What was the default rates you were expecting when you made the loans and what actually happened? And if that is better than you were expecting, then you had better than expected performance. Going on here, our 70 plus bank and credit union partners who typically retain loans in the lower risk grades appropriate to their businesses have seen to date portfolios consistently meet or exceed expectations since the program began in 2018. So, what they're saying is that the lower risk loans that they've been handing out have performed better than what their bank partners were expecting. But that's not all of their business because they do make loans. A significant amount of their loans are to lower credit rating borrowers or subprime borrowers. This is talking about lower risk borrowers, which are higher credit rating non-subprime borrowers. A loan buyer who invested equally in all cohorts since the first quarter of 2018 would have experienced a positive return on all vintages thus far, with an overall 9.8% gross annual return. So if you had been with Upstart since the first quarter of 2018, investing equally in every quarter, let's say 200 million in every quarter, this is the return you will have gotten. Here's the big news. Here's the big news for Upstart stock investors, and the negative news for Upstart stock investors is this proclamation here, which says we're in a funding constrained environment, which is the primary cause of our revenue shortfall. What this means is that Upstart is finding that lenders are not coming onto their platforms to lend money. There isn't money to be lent. Of course, borrowers will want to borrow even more, or arguably maybe especially lower credit quality borrowers may want to borrow more when their economic prospects are dwindling, when they're getting laid off from jobs, when they're not experiencing wage growth, when inflation is pinching their budgets. They may want to borrow more money at that point, but that's exactly the same time that lenders do not want to lend out money. Lenders don't want to lend you money when you lose your job. That's not when they want to lend you money, but that's when arguably is the time when you want to borrow money, when you lost your job and you need it. So there's a mismatch here. There's not enough funding on their platform right now, even though they still have, they're not talking about a reduction in borrowing demand, but from a funding standpoint, they are noting a significant constraint here. They go on to talk about some of the banks, their partners. Several of them have paused or reduced originations due to fear about the future of the economy. And this is typically what happens with banks. This is what they do. They know the market cycle. They know that when we're entering a recession is not a good time to be lending out money. There's going to be lots of job losses in the next few quarters, in the next few months. When Federal Reserve continues raising interest rates, that typically has the follow-up effect of causing job losses. And in fact, the Federal Reserve is forecasting job losses. They're forecasting the unemployment rate to rise from 3.5% to 4.5%. And so this is not a time that banks want to be lending money. So as a result of these changes, they've concluded that they need to upgrade and improve the funding side of the marketplace, bringing a significant amount of committed capital on board from partners who will invest consistently through cycles. That's the key word, is invest consistently through cycles. Not only invest during favorable times and decrease funding during unfavorable times. What Upstart is looking for is investors that are willing to invest through cycles, not up and down, right? So they're evaluating a variety of opportunities to do that, though they expect this will take some time to bring to fruition, which is to be expected. Lenders, like I mentioned earlier, are not, keen on lending during times of economic downturns, during times of recessions. That's not a prudent time to be lending out money. And so I don't know how Upstart is going to incentivize investors to fund during those times of unfavorable economic activity. Maybe they need to promise a higher rate of return. Maybe they need to promise higher fees, maybe higher guarantees. I don't know just how they're going to do that, but I know it's going to be difficult. And they even mention here that they expect it will take some time to bring to fruition, and ultimately it may never happen at all. It's going to be difficult to bring on those kinds of funding sources. That remains to be seen, and it's certainly something I'm going to be following as I follow Upstart stock in the next few quarters. For now, they've decided that it makes sense to leverage their own balance sheet as a transitional bridge to this committed funding. So what they're going to do for now is they're going to use their own money. Upstart is going to use their own money, take the risk on themselves to lend the money. And they acknowledge that this is a shift relative to what we planned and communicated earlier this year. So they said they weren't going to do this, but now they need to do this because they've noticed funding dry up so much that they need to step up and lend to some of these customers. Otherwise, transactions on their website could significantly fall. And so they've stepped up. But ultimately, this means more risk for upstart stock investors because they are now exposed to the potential for defaults from these customers that they're lending to. Still, they believe the opportunity to generate outsized profits on our platform is unusually high right now. Unusually high because partly due to the fact that other lenders have pulled out, and so there is limited competition on the funding side. So when there are good opportunities, there is not competition for it. So the ability to earn outsized profits is unusually high. With the caveat, I will note that this is potential profitability, right? Because you don't know what the default rates are going to be to the people that you're lending money to right now when the risks of a recession are unusually high in the near term. This is good news that they continue to add new lenders to the marketplace with 71 banks and credit unions as of today, up from 57 from May. But the key is how much money are these partners actually putting up? I could sign up and say, "Yeah, I want to be a part of your platform," but I'm barely putting up any money when I'm on your platform. The key is to get these institutions not only to sign up to the platform, but also to encourage them to start lending out money. In a quarter of mostly bad news for upstart stock investors, here's a bright spot in this highlighted segment. In just a couple of weeks, we merged our machine learning model for automated income verification, originally developed for our personal loan product, is now integrated in their auto retail lending flow. We expect this improvement to more than double the percentage of applicants for whom they can automatically verify income. And broadly speaking, this is one of the main theses for investing in upstart stock is the fact that they are an improvement from traditional lending methods where you have to present all of these documents to your lender and they need to go through all of your files to verify your income, sign these papers and all of that. It's a big hassle. And one of the main advantages that Upstart offers is these automated loan approvals, making the process much faster and thereby making it much more convenient for consumers. And here's this segment here is good news for upstart stock investors that they've extended their automated income verification to beyond personal loans and into car loans. So management takes a moment to reiterate its mission, which is to leverage modern technology and data science to improve access to affordable credit. They believe that the terms non-prime, near-prime, and subprime are words the industry invented to describe people that our current systems don't understand. The truth is that the vast majority of these Americans are entirely credit-worthy. So they're trying to focus on these lower credit score customers and they believe that they are underserved. They believe that the risks to lending to these cohorts are overrated, and Upstart believes that they have a superior model to serving these customers. Their goal is to deliver the return the lender or investor expects for a specific allocation of risk. That's good, but here's a statement that alarms me a little bit. I will admit, is this statement here. We don't strive for loan transactions that lose money for Upstart and generally seek to avoid them. Why only generally do you seek to avoid loan transactions that lose money? Shouldn't you always look to avoid these transactions? Always trying to avoid transactions that will lose money? I would have preferred that verbiage instead of saying generally seeking to avoid them. I don't want a company that I invest in to be making loans that could or making loans where they are expected to lose money. That's not a good sign there. So now we're moving on to Sanjay Datta, who takes over for the CEO in this conference call and says that the industry data show a general rise in delinquencies, across all segments of unsecured credit, disproportionately impacting the higher risk tiers, primarily the type of customers that Upstart goes for, that comprise the significant component of our borrower base. That's yes, that's what's going on. And that's the risk of focusing on a cohort of customers that are rated lower tier or subprime, is that during times of economic contraction, these are the cohorts that are most affected by those times and experience higher than usual loan defaults. And so this is what they're experiencing. One more sign of good news for Upstart stock investors is the company announced a stock repurchase authorization, and they repurchased 4.4 million shares of Upstart stock, totaling $150 million. And to raise the money to buy back Upstart stock, they sold a meaningful amount of the loan assets from their balance sheet to fortify their cash position. I always like to see this as an investor when management is buying back shares of their stock. It tells me that they believe in their stock, they believe the stock is undervalued, and so that's encouraging from an investor's standpoint. And despite all the bad news that they've been talking about, net revenue in the second quarter was still up 18% year over year. The volume of loan transactions on the platform was 321,000, up 12% year over year, representing 233,000 new borrowers. So they're still experiencing growth despite all of these headwinds and bad news. And this is a smart move, in my opinion, a prudent decision to reduce their sales and marketing team by 21% as they downsize their marketing campaigns to reflect the constrained funding supply. If you don't have money to lend out, you don't want to be spending money on advertising to attract new borrowers. So that's a prudent decision, in my opinion, for Upstart management to reduce sales and marketing by 21%. And they ended the quarter with 790 million in unrestricted cash, up mildly from 758 million in the first quarter. So they lost 29 million, they lost 30 million in the quarter, but they have 790 million in cash. So the quarterly losses compared to their cash balance is, not alarming at this point. It's not alarming. And so I'll finish with this last statement here that the CFO makes, is they must confront the fact that the largely uncommitted nature of our third-party funding has proven inadequate to the task of navigating the current market turbulence, and we have turned our efforts toward building a more resilient funding model over time. The key word being that it's proven inadequate. And this is, if you've watched my video, I have a video on is Upstart stock a buy. One of the main risks I note for investing in Upstart stock is that the company has not been through a few economic contractionary cycles to determine the viability of their business model during those economic recessions or contractions. That's a risk for the company, and this is one reason this is coming to fruition here, is now that they're going through one of these cycles, they're realizing, oh, wait a minute, this is inadequate. This part of our business model was not adequate to deal with this fact. And so they're not going to find out these inadequacies until they go through those recessions. And as an investor in Upstart stock, that's a risk that you're taking, that when they confront these recessions and downturns, that they're going to realize things about their business model that they don't know yet, that they're thinking is effective, but when it comes down to it, may not be effective. And so that's a risk for Upstart stock investors. All right, so That's all I've got for this deep dive into Upstart conference call and to get a better idea of what's going on with Upstart stock. Thank you for watching, and I'll see you next time for another installment of a conference call deep dive. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 354% as of September 21, 2022, and measured against the S&P 500 returns of 112% as of September 21, 2022.